Hello, Arizona, and thank you for listening to this podcast of Valley of the Sun Real Estate Show. I am your host, Jayson Bates, the lender who's been known to take a turn down and turn it around into an approval. And I am wanting to talk about a subject, so I'm going to really kind of dive into it here in just a bit. But if you want to reach out to the show, by all means, please email me. If you have a topic that you'd like to talk about, then please just email the show at Valley of the Sun Real Estate Show at gmail.com, or you can call me at my direct line at 602-573-3101, and I'd be more than happy to go over the subject matter that you'd like to touch base on. But today's subject is, should I consider refinancing out of my FHA loan into a conventional loan? And I'm seeing a lot of commercials and hearing a lot of commercials on the radio about this very subject. So I thought it was kind of important to kind of put this out there and really get the meat and potatoes out there as to the pros and cons of it. Now, I did an episode before on a podcast where there was the pros and cons of an FHA loan versus a conventional loan. And so if you want to hear those differences between the two different types of loans, by all means, check out that episode. But in today's episode, I want to go over, if you have a current FHA loan and you're getting solicitation to possibly refinance that into a conventional loan. And so I always tell my clients that when I do a loan or do an application with somebody, I always give them options when it comes to their financing needs. And one of those options is the difference between the FHA and the conventional loan. A lot of people don't know the differences. The key factors here on the FHA loan, there's some lenders out there, unfortunately, who try to steer lenders into an FHA loan. And that is just wrong. There's just no way about that. So that is just something that we don't want to have you in, right? So now, having said that, we want to put this together so that you can understand, or I want to put this together so you can understand the differences here. So when you're in an FHA loan, there's a couple reasons why you might be in that FHA loan. You might have a short sale or a bankruptcy or a foreclosure in your past. And if you do, then the waiting periods on those FHA loans is much shorter than what's required on a Fannie Mae or conventional loan. So with that being said, if you have something, a bankruptcy or anything like that in your past, then we may have to wait before you can get in that conventional loan. But if you don't have any of those issues, then these are some key factors as to why I think an FHA loan or a conventional loan is a little bit superior to an FHA loan. So I want to go over those here. So let's kind of dive right into that. So right now, interest rates are really, really good. And we've seen an improvement here on interest rates, and it's starting to get to that point where, yeah, you may have an FHA loan that has a good interest rate, but conventional interest rates aren't that bad either right now. And so that is something that we want to kind of, take in consideration here, because interest rates obviously influence the payment. And, if you can get an interest rate that's relatively similar to what you have as an FHA loan and get that into a conventional loan, then it's something worth considering. Now, the big benefit here, and the reason I bring up the interest rates, let me back up here for a minute, because the reason I bring up the interest rates is because interest rates coming down as they are, all indicators are that interest rates will be going up. And there's some contributing factors to that. There's more and more people coming out of that penalty box that I've spoken to or spoken about before in the conventional or in the, if you've had that short sale bankruptcy or anything like that in the past, more people coming out of that penalty box. There is some scuttlebutt right now that FHA may even be raising some of the costs and some of the fees to obtain an FHA loan. If you think back between now and the 2008 financial crisis that happened in our country, a lot of people turned to FHA for financing on a home. And so the government, in for a short period there, even 2008 to 2010, 11, people who got an FHA loan during that period ended up even going into foreclosure. And so the FHA loan is an insured loan. And so when you have a foreclosure on an FHA loan, the government pays the bank up to 80% of that loan balance as security to the bank for extending credit to that particular person under the FHA program. So it's like an extra insurance policy, if you will, to the bank. So they really don't lose a whole lot of money on those deals. They do lose money. Don't get me wrong. I'm not saying they don't. However, when something's insured for 80%, I mean, your losses are cut dramatically. So as a result, FHA has a little bit better pricing typically than a conventional loan. And they dig a little bit deeper when it comes to credit. So those waiting periods are a little bit shorter than when it comes to the conventional loan. Now, there is a movement right now to move the conventional loan closer to the FHA guidelines. And when that happens, and there's a big push politically to make this happen because the government does not want to insure America. They don't want to have an FHA loan in every single house in America. So we've seen some changes here for FHA as far as the loan limits here in Maricopa County. The maximum loan limit, 2 L's. There's kind of a little bit of a tongue twister, but having the loan limit set at $271,050 here in Maricopa County, that then restricts the potential buyers in purchasing a home. So your loan amount's got to be less than $271,000. Whereas a conventional loan here in Maricopa County, and really in the state of Arizona, the entire state, it's $417,000. So if you're going to be purchasing something and you need financing between that $271,000 and $417,000, you're going to be looking at conventional financing for that type of loan, or VA loan. VA also accommodates up to $417,000. So now, with that being said, with the interest rates coming down here as of recent, and I'm not going to quote interest rates because, here today, gone tomorrow kind of thing. But with interest rates being relatively low as opposed to what they were even 6-7 months ago, it's getting to that point where you can refinance into a conventional loan and then drop the mortgage insurance cost, maybe even drop it completely. And this is something that I want to get into more and more here with you, because mortgage insurance, PMI, private mortgage insurance, is for the conventional Fannie Mae, Freddie Mac. MI, mortgage insurance, is for the FHA. And so the MI, mortgage insurance for FHA, if you put 3.5% down or less than 5% down, it's 1.35% monthly. In addition to that MI factor that's tacked onto your mortgage payment, you also have an upfront MIP, mortgage insurance premium, that's added to your loan, and that's 1.75 currently. Now, those things are possibly going up. Those MI calculations are possibly going up for FHA. On the private mortgage insurance, and you can go, and I'm going to put some links here in my blog, and you can certainly visit my blog at Valley of the Sun Real Estate Show at blogspot.com. And by going there, you can see this episode and listen to this episode, but I'm also going to put some links in there to some private mortgage insurance companies where you can actually get quotes online. And these are exact same quotes that I use. Radian is one of the companies that I use. There's several of them. Magic is one of them. Another one of them that's very popular. But if you go to Radian and you go to their rate finder, you can actually play around and see what the mortgage insurance rates might be for you. Now, I bring this up because the private mortgage insurance, the cost for the private mortgage insurance is much less. If you have a 640 credit score, the monthly MI would be 1.15. That's the monthly. That's at 90% loan to value. Okay, so, and that's with a 640 credit score. Now, typically, if you get into an FHA loan and you get the mortgage reported on your credit report, your credit score is probably going to go up. So I did a little bit of assuming here that you had a low FICO score, and you have the mortgage on there, and you've had that mortgage for at least 6 months. And now your credit score, your FICO score, has improved as a result of you making your payments on time on that mortgage. And therefore, with that being said, I'm using 640 as a minimum credit score. Now, they will go down on the mortgage insurance companies. To get mortgage insurance, you can go down as low as a 620 credit score. So credit scores really aren't that big of a factor in determining whether or not you can qualify for a conventional loan. And so if you have credit problems, by all means, please reach out to me. email the show, Valley of the Sun Real Estate Show at gmail.com. I'd be happy to do a one-on-one consultation with you and go over your credit. If you're not in a position right now, credit-wise, I will give you specific guidance on what you need to do to improve your credit so that you can be there and we can see the light at the end of the tunnel for you. So please reach out to me if you have any credit concerns that you're kind of dealing with and don't know what to do. So with that being said, now at 640 credit score, now all of a sudden you can get cheaper MI than what you're going to get on the FHA loan. Now, with that being said too, the FHA loan with that MI is for the life of the loan. So that's for 30 years. You got to pay that mortgage insurance no matter the equity position that you have in the property. That's huge. So that's a lot of money that you're throwing at mortgage insurance that you're not maybe not seeing the, may not have the benefit of. So mortgage insurance in the past has always been seen as a waste of money. Now, if you make under $100,000, I do believe that that is tax deductible. I would advise consulting with your tax advisor on that. Because I don't know if that law has changed, and I don't really stay up with all the tax laws out there, but I know at one point with the financial downturn in our country, they did make mortgage insurance tax deductible, but you had to make less than $100,000 a year. But do consult with your tax advisor on that to see if you qualify for that. Now, on the private mortgage insurance, because it's 1.15, and mind you, if your credit score is higher, you're going to have less, or you're going to pay less in mortgage insurance. Now, this can be a significant savings to just refinancing even with mortgage insurance, because you're going from 1.35% down to, as low as I think it's 0.67 or 0.57, I think is the lowest MI, maybe 0.47 if you have over 740 credit score. So with that can be a huge savings right there. I mean, you're taking almost of a point off, and depending on your loan amount, that could be a significant amount of savings. Now, the other key factor in this, in the mortgage insurance, and why you should consider refinancing now, not only to take advantage of the low interest rates and get the lower MI, but also for the future, because you're going to, once you're in that conventional loan and you're at 80% loan to value or less, the mortgage insurance will drop off. Now, the burden of proof is on you to prove to the mortgage company that their exposure is less than 80%. So let me repeat that. Your burden of proof is on you to prove to the bank that their exposure is less than 80%. So how do you do that? Well, the only thing you need to do is have an appraisal done. And so you have an appraisal done of the property. It shows the new value of the property. You submit that to your service provider. They drop off the mortgage insurance completely. Now, the reason that's so important is because the cost of the appraisal is the only thing you would need to do to drop that mortgage insurance completely. So typical appraisal is anywhere between $400 to $475 here in Maricopa County. That's about an average, $400 to $475. Where if you're in an FHA loan and you think you need to have all this equity in order to refinance so you can drop off the mortgage insurance, which you do, you need to have that 20% equity. Don't get me wrong, but there's other alternatives, and I'm going to go over those here in just a second. But taking advantage of the low interest rates today, because if you refinance, if you wait a couple years down the road and you want to refinance, you're going to be subject to the interest rates down the road. And all indicators, as I said earlier, are pointing to higher interest rates in the future. So take advantage of the interest rates now if you can. The only thing really stopping you, and I got to say this before I forget it, but the only thing really stopping you right now from getting into a conventional loan, if you're a homeowner, would be if you had a short sale, foreclosure, or bankruptcy in your past. Okay. So if you had any of those things, now they did change that to 4 years. So if you're over 4 years on those items, then you need to call me. There are some restrictions on those. Economic event, if you had an economic event, it's 4 years. Otherwise, it's really 7 years. But we're really getting close to everybody having 7-year seasoning, or a lot of people anyway, having 7-year seasoning on that economic event or that bankruptcy or foreclosure or whatever the situation may be. So So if you've had that would be the only thing that would be preventing you from refinancing into a conventional loan. Conventional loans will go up to 95% on a rate and term refinance for your loans. So you don't need a lot of equity. You don't need that 20% equity. So at 95%, you can wrap in all your closing costs, get the lower MI, take advantage of today's rates, and really position yourself in the future so that all you got to do is do an appraisal on the property and then drop the mortgage insurance and not be subject to the higher interest rates in the future. And the other thing too that you would be subject to in the future, you would be today as well, would be closing costs. I mean, the closing costs typically on a refinance, as a rule of thumb, with everything included, is about 1.5 to 2% of the loan amount. That's about an average. It might be a little bit cheaper with some companies. I try to make it a lot cheaper. I try to make it around 1%, depending on the loan amount. And whatever's in your escrow account, remember that you're going to get that back as cash. And I know I'm kind of jumping around here and I'm getting all this information out there, so I do apologize about that. But there's a lot to consider here on this refinance. So the key points here that I want to get out there is that you don't need a lot of equity in order to refinance. You don't need to have the best of FICO scores or credit scores. And right now is a good time to take advantage of the lower interest rates to position yourself in the future that you don't have to refinance and be subject to the higher interest rates. So that's pretty much the whole benefit, if you will. And like I said, I do a whole podcast on the pros and cons of an FHA loan versus a conventional loan. But I wanted to get this out there for the refinance. If you're getting a solicitation in the mail and you're considering refinancing, then I wanted to get this message out there so that you can kind of better assess your situation to see if a refinance might be in the works for you or an option for you. And like I said, you can always reach me at Valley of the Sun Real Estate Show at gmail.com, or you can call me directly at 602-573-3101. I hope that this clears up the air for you a little bit. You can check out my YouTube channel as well. That's YouTube /the Jay Bates, Jaybates. You can check out the videos there. I do, a video of this podcast as well. So I try to do that anyway. So check that out. You can always reach me on Twitter as well. It's Jayson, Jayson, Bates, Bates is my Twitter handle. So I hope this helps here for you, and I hope that I clarified a couple things. I know I ran through a lot of information, but if you didn't catch it, please rewind it and listen to it again. Or, like I said, reach out to me. I'd be more than happy to go over your particular situation. So once again, thank you very much for downloading this or listening to this podcast of Valley of the Sun Real Estate Show. I really appreciate you taking time out of your day to listen to what I have to say. And until next time, take care, and I look forward to hearing from you very soon. Bye-bye.